Listen, if you're building or investing in SaaS right now, that old growth playbook, it's completely broken. You already know acquiring customers is getting brutally expensive, and those flat monthly subscriptions just aren't cutting it anymore if you want to actually survive. Welcome to The Explainer. Today, we're tearing down the old model and looking at a massive shift that separates the companies barely scraping by from the ones absolutely crushing it. We're talking about turning your software into a fintech ecosystem as the ultimate growth lever. Take a look at this, 82%. That is the percentage of companies right now suffering from moderate to critical cash flow disruption purely due to late payments. Think about that for a second. You do all the heavy lifting, you close a massive deal, but the actual cash, it lags months behind. Waiting 60, maybe 90 days for a client wire transfer is agonizing. And in fast-scaling sectors like SaaS, that kind of lag isn't just an annoyance, it is literally a silent killer. So you've got to ask yourself, is your SaaS quietly leaking revenue? I mean, sure, your sales pipeline might look super healthy on paper, your bookings are up, but if your upfront cash is stalling out while your customer acquisition and product costs are hitting your bank account today, you are caught in a massive trap. This cash gap is exactly what's strangling software companies in the current market. All right, let's get right into part one, the 2026 SaaS growth trap. The sheer scale of this problem is pretty staggering. Over the past 5 to 8 years, SaaS customer acquisition costs, or CAC, have skyrocketed. We're talking anywhere from a 60% to over a 220% increase. So if your entire growth strategy relies solely on hunting down new logos, those costs are going to eat your budget for breakfast. The math simply doesn't work the way it used to. And because of those insane costs, the metrics that investors and founders actually care about have fundamentally shifted. Look, chasing top-line monthly recurring revenue, MRR, that was the old obsession. It relied on flat subscriptions and a heavy dependence on constant, super expensive acquisition. But net revenue retention, or NRR, that is the cardiovascular fitness of your SaaS. It measures expansion, product stickiness, and ecosystem growth. It is absolutely the new standard for survival. Now, quick warning here. You gotta watch out for what's known as the 100% NRR trap. Even a really impressive high NRR can be super dangerous if your gross revenue retention, your GRR, drops below 85%. What happens is, massive upsells to just a few huge clients can secretly mask the fact that you're actually bleeding everyday customers. If your underlying logo churn is high, it means your core product just isn't sticky enough. You're basically trying to fill a leaky bucket. Moving on to section 2, NRR, the new North Star. Check out these 2026 Chart Mogul benchmarks. Notice how the numbers scale up as the annual contract value increases. Down at the bottom, for strategic enterprise deals over $100,000, top companies are hitting an incredible 122% net revenue retention with only a 5% median annual logo churn. And here's the kicker. Companies hitting these elite benchmarks, anything above 110 or 120%, are actually growing up to 3 times faster than their peers. Plus, a massive 40% of new annual recurring revenue now comes strictly from existing customers. So the takeaway here is crystal clear. Expansion is unequivocally the cheapest growth engine you have. Selling more to someone who already trusts your platform is infinitely more cost-effective than paying that inflated 220% acquisition cost just to land a brand new logo. The Bessemer Cloud Index actually summed this up perfectly. They noted software and payment models are increasingly the go-to combined monetization strategies that drive market dominance within certain vertical industries. This right here is the secret. The major players aren't hitting that elite 120% NRR just by shipping more software features. They are getting there by combining their software directly with financial services. Which brings us nicely to section 3, the embedded finance power play. So what are embedded services? It's when you integrate capabilities like payments, B2B lending, payroll, or insurance directly into your core software platform. The goal is super simple. Your customers shouldn't need to duct tape together multiple vendors. Nobody wants to export a CSV just to run payroll or reconcile invoices in a completely separate tab, right? By embedding these financial rails directly into the invoice or checkout workflow, your software instantly goes from being a nice-to-have tool to a totally indispensable piece of operating infrastructure. And the immediate impact of this shift, it is undeniable. 88% of companies report increased user engagement and 85% report improved customer acquisition the very moment they add embedded finance.
Think about it. When your software natively handles a customer's money, their trust, and their compliance, engagement absolutely skyrockets because you're solving their biggest operational headaches right where they already work. Let's look at Section 4, non-dilutive capital for scale. Now, this is a critical point for any founder watching, and honestly, it's a massive emotional relief. You can keep 100% of your equity. Because B2B SaaS revenue is highly predictable, you can actually use your recurring subscriptions to secure growth capital. Lenders can underwrite your MRR with real confidence. That means you don't have to face crushing VC dilution just to get the cash you need to scale your go-to-market strategy. But you've got to choose the right partner. When you're evaluating B2B lending platforms, you need to scrutinize their cost structure and their speed of funding. Dig into their risk appetite, like do they actually understand your specific churn metrics? And most importantly, you have to look really closely at integration and customer experience. You definitely do not want to get trapped by hidden tech costs that end up outweighing the financing itself. Let's walk through a real-world example using an embedded tool like Ratio to see how this magic actually works. Step 1. Your enterprise buyer gets to check out and opts for flexible net 60 terms, mostly because they want to hold on to their own cash. Step 2. The embedded lending platform steps in and pays you, the SaaS provider, the full contract value upfront minus a small 2 to 4% fee. Step 3. You immediately take that upfront cash and reinvest it right back into your growth. The buyer gets their flexibility, you get instant cash. It is a total win-win. Just doing a quick scan of the competitive landscape here, you'll see there are different tools for different needs. Ratio's incredible for embedded buy now, pay later right at checkout. And get this, it can actually boost close rates by up to 18%. Then you have platforms like Clearco and Pipe offering unique revenue trading mechanics where you basically trade your ARR for upfront capital. Mercury consolidates your banking and credit, and LendFlow acts sort of like a marketplace to shop for rates. Making the right choice here turns payment flexibility into a massive competitive advantage. Let's bring it all together in Section 5, building a sticky ecosystem. This creates a really stark contrast in the market. A generic, broad horizontal software is super vulnerable. It can be easily copied, undercut on price, or just completely replaced by a larger enterprise suite. But a vertical micro SaaS, one that owns a specific workflow and embeds payments or payroll, that becomes incredibly hard to rip out. You literally transition from being just a simple tool to becoming permanent infrastructure. As industry analysts point out, you are more likely to win with a narrow product that owns one workflow, fits one industry, and ties value to money, trust, or compliance. Adding transaction-based income on top of your flat subscriptions, well, it isn't just a neat feature anymore. It is the definitive playbook for absolute scale and unbeatable customer retention. So I want to leave you with a final provocative question to chew on. Will your software own the entire workflow or just the subscription? Because if you only own the subscription, you are vulnerable. It is absolutely time to rethink the depth of your product and seriously explore how embedded finance can make your platform indispensable. Thanks for joining me on this explainer, and I'll catch you in the next one.